Usually when we talk about tax season, there is this collective shared image of a frantic December scramble.
Oh, yeah. A total last-minute panic.
Right. It's like everyone is rushing around trying to buy last-minute holiday gifts, except, instead of gifts, you are rapidly logging into your brokerage account.
Yeah, just desperately looking for a few losing stocks to sell.
Exactly. Just to strip together some deductions before the clock strikes midnight on New Year's Eve.
It's treated like the seasonal chore. You sweep the dust under the rug, lock in a few losses, and feel this weird sense of relief that you did something proactive.
Yeah, before the calendar flipped.
Right. But it is a remarkably reactive way to manage money. I mean, it's just not efficient.
It really is. It feels like a quick cleanup. But then you step into the world of high net worth portfolio management, and suddenly that December rush looks, well, completely amateur.
Oh, completely. It's a whole different ballgame.
Because we're looking at a financial landscape where tax loss harvesting isn't a year-end panic at all. It is a highly engineered, year-round wealth-building engine.
It requires a fundamental paradigm shift. You have to stop looking at market volatility as just a risk to be managed.
Okay, so how should you look at it?
You start seeing it as an inventory of tax assets just waiting to be claimed.
Welcome to the Deep Dive. Today, we are exploring a really fascinating guide created by Davies Wealth Management. They are a fee-based fiduciary advisor out of Stuart, Florida.
Yeah, and this is great material.
It really is. This guide was originally put together for the 1715 Treasure Coast Financial Wellness podcast, and it details 7 advanced tax loss harvesting strategies specifically designed for multi-million-dollar portfolios.
Which is where things get really complex.
Right. Okay, let's unpack this. This deep dive is really for you if you want to understand how the ultra-wealthy use the tax code as a continuous strategic tool rather than just, reacting to it once a year.
And to truly grasp the urgency of this, we have to look at the math, because the math shifts dramatically once you cross that $1 million threshold in investable assets.
So set the table for us. What does the 2026 tax landscape look like for these folks?
Well, if you are a high earner right now, your top long-term capital gains rate sits at 23.8%.
And just to clarify for the listener, that 23.8% figure, that isn't just the base capital gains rate, right?
That's a really great point. The base rate is actually 20%, but that 23.8% includes the net investment income tax.
Ah, okay. The NIT.
Exactly. That is an extra 3.8% surcharge that the IRS tax on to investment income for higher earners. So you are losing nearly a quarter of your long-term gains to federal taxes right off the bat.
Wow.
Meanwhile, your short-term gains, which, are taxed as ordinary income, those can hit you with up to a 37% federal tax rate.
Those numbers are just massive when you were dealing with large portfolios.
Right.
There's actually this striking example in the source material that really hammered this home for me.
The Stuart, Florida couple.
Yes, that one. They mapped out a scenario for a married couple living in Stuart, Florida. And keep in mind, Florida handily has no state income tax, which is a huge advantage.
Yeah, massive.
But let's say this couple has $600,000 in annual investment income. For them, every $100,000 in harvested losses is worth up to $23,800 in federal tax savings.
And we need to be really clear about what that savings actually represents. That is not a deferred tax where you just pay it later down the road.
Right, it's not a delay.
No, that is eliminated tax, provided those harvested losses are used to offset existing gains in your portfolio.
So that money stays in your pocket.
Permanently. When you recognize that level of actual hard dollar savings is on the table, you realize you simply cannot afford to only look for those opportunities in December.
Which means logic dictates a massive shift in tactics. Since the math shows how incredibly valuable these losses are, waiting for December to harvest them it's basically like only shopping for sales on Black Friday.
That's a perfect analogy.
Right. Because yes, you might find a decent deal, but you completely miss the massive discounts that happen during, a random February market pullback or a summer sector rotation.
The market is constantly moving,
Right.
right? It creates these temporary windows of opportunity. If a correction lasts 3 weeks in April and you aren't paying attention,
The loss is just gone.
it's likely completely gone by the time December rolls around. The market recovers, the position is back in the green, and you miss the harvest.
This is why a systematic, rule-based approach is required. Fiduciary advisors will monitor every position in a taxable portfolio continuously.
But what's crucial at the high net worth level is understanding that absolute dollars matter significantly more than just percentages.
Let's break that down. What does that difference actually look like in practice for a portfolio?
Well, let's look at the thresholds you might set. If you have, say, a $20,000 position and it drops 3%, that generates a $600 loss.
Okay, not nothing, but
But at that level, actively monitoring it and paying potential transaction or spread costs to trade it, well, it might not be very efficient.
right, the juice isn't worth the squeeze.
Exactly. But if you have a $500,000 position, that exact same 3% decline yields a $15,000 harvestable loss.
Oh, wow. Yeah, that changes things.
That is absolutely worth the transaction cost and the operational effort. So you establish tiered harvesting thresholds based on the actual dollar size of the position, not just, a flat percentage drop across the board.
That makes total sense when you frame it around absolute dollars. But wait, I have to push back here a little bit.
Sure.
If I'm aggressively selling my losing stocks all year round just to capture these tax breaks, aren't I just sitting in cash?
I hear this all the time.
Right, because what if the market bounces back the very next day? I've banked a tax loss, sure, but I've completely missed the recovery.
That is the exact fear that keeps retail investors from utilizing this strategy. And the IRS actually has a rule designed specifically to prevent people from just, selling a stock for the tax break and immediately buying it back.
A wash sale rule.
Yep, the wash sale rule. It essentially says you cannot claim a tax loss if you repurchase the same or a quote-unquote substantially identical security within 30 days before or after the sale.
So that creates a 61-day window where you can't just buy back what you sold.
Precisely.
So how do you avoid sitting on the sidelines in cash for 2 months while the market potentially shoots up?
You utilize a strategy called precision replacement. You do not stay in cash.
Okay.
You swap the asset for something highly correlated but legally distinct. For example, if you sell a Vanguard S&P 500 ETF to harvest a loss, you might immediately purchase a Schwab or iShares equivalent that tracks the exact same index.
Oh, I see.
You maintain your exact market exposure, so if the market bounces back the next day, you catch the write-up. But because they are technically different funds managed by different companies...
You still legally bank the tax loss.
Exactly. You can also use factor substitution. Say you harvest a loss on a broad, large-cap fund. For those 30 days, you might swap that capital into a fund that focuses specifically on undervalued large companies, a large-cap value fund.
So you stay invested in a similar asset class without violating the wash sale rule.
You got it.
Okay, so ETF swapping keeps you in the market. You are keeping your exposure, but changing the label on the bottle, essentially. But let's say the overall S&P 500 is up 20% for the year.
A great year.
Yeah. Everything is in the green.
Yeah.
ETF swapping doesn't help much if every broad ETF you own is up. Are there even any losses left to harvest in a roaring bull market?
That's the million-dollar question.
And here's where it gets really interesting. The Davies Guide highlights what is arguably the ultimate tool for multi-million-dollar portfolios to solve this exact problem. And that is direct indexing.
This is a game changer.
With direct indexing, instead of owning one single ETF like one picker symbol that represents the whole S&P 500, you actually own the 400 to 500 individual stocks that make up that index in a separately managed account.
And what's fascinating here is how this completely changes the math of a bull market. Even when the broader market is up 20%, dozens and dozens of individual companies inside that index are going to be having a terrible year.
Right. They will be in the red.
Direct indexing allows you to surgically extract those individual losers. You harvest the tax loss on those specific underperforming companies, and you leave the hundreds of winning stocks completely untouched so you can keep tracking the market's upward momentum.
You are basically sifting through the index to find the hidden losses.
Precisely. And the impact is substantial. According to Vanguard research that was cited in the guide, this strategy can generate an additional 1% to 2% in after-tax alpha annually for taxable accounts.
And for you listening, when we say after-tax alpha, we're talking about effectively beating the market's return by 1% to 2%, purely through the value of the tax savings you are generating.
Right. You aren't taking on more investment risk.
Exactly. You are just being radically more tax efficient.
Yes. And over a 20-year period on a multi-million-dollar account, that compounding difference in tax savings is staggering. It's huge.
The source material gives a really practical example of how you avoid the wash sale trap at this individual stock level, too. Because you own the individual stocks, you can harvest a loss on, say, Boeing and immediately swap that capital into Raytheon.
That's a perfect example.
They are in the exact same aerospace sector, so your overall portfolio stays perfectly balanced in terms of industry exposure.
But because Boeing and Raytheon are fundamentally different businesses, different management, different balance sheets, they aren't substantially identical companies, according to the IRS.
So no wash sale violation.
None at all. It is a brilliant mechanism.
Hmm.
Now, it is worth noting this requires significant capital to execute properly. Historically, direct indexing needed, well, $1 million minimum just to ensure proper diversification across hundreds of stocks and to manage the trading fees.
Yeah, makes sense.
For investors managing large taxable accounts, this is arguably the most powerful harvesting tool available, though it does introduce massive operational complexity that frankly requires sophisticated software to run.
So we are generating all these synthetic losses through continuous monitoring and direct indexing. But a loss doesn't do anything on its own right. It's essentially a coupon.
That's a good way to look at it.
You have to apply it to a gain for it to have any actual value.
Yeah.
How does the IRS force us to sequence these?
This is where we get into the architectural design of a portfolio. The matching rules matter tremendously here. The IRS dictates a specific sequence. Short-term losses have to offset short-term gains first. And long-term losses offset long-term gains. If you have excess losses in one category, only then can they cross over to offset gains in the other.
And harvesting those short-term losses is incredibly powerful because, as we established earlier, short-term gains are taxed at that brutal 37% ordinary income rate.
Exactly.
So aiming a short-term loss at a short-term gain provides the maximum possible tax shield.
It does. And this becomes a critical wealth protection tool for executives or founders holding concentrated stock.
How so?
Think of someone who has spent a decade accumulating a massive amount of their employer's shares, and the cost basis is incredibly low. They can't just sell all of it without triggering a catastrophic tax event.
Right. If they have $5 million in company stock and want to diversify, selling it outright would mean losing a massive percentage of that wealth instantly to the IRS.
But if that executive is utilizing a disciplined tax loss harvesting program in their broader portfolio over several years, they are actively building what we call a loss reserve.
A loss reserve.
Yeah. Let's say they harvest $100,000 in net losses every year for 5 years. They are creating a bank of carry-forward losses.
Because you can roll them over.
Yes, the IRS allows you to use any net capital loss to offset up to $3,000 of ordinary income per year, but the beautiful part is that you can carry the remainder of those losses forward indefinitely.
Indefinitely.
So when that executive finally decides to diversify and sell a large chunk of that highly appreciated company stock, they can deploy that $500,000 reserve of carry-forward losses to partially or even fully shelter the transaction.
They're essentially pre-funding their future tax shelter. By taking small strategic losses today, they are buying the freedom to safely sell their concentrated wealth tomorrow.
Exactly.
But to pull that off, your portfolio has to be meticulously organized, which brings up the concept of asset location. It's not just about what you own, but where you own it.
Location is everything.
I like to think of asset location kind of like driving on a highway system. If you put your highest growth, heavily taxed assets in a regular taxable brokerage account, it is like driving on a highway with the parking brake engaged, stopping to pay a toll at every single mile marker.
That sounds miserable.
It is. The taxes just drag on your performance. You want those high growth assets in a Roth IRA, which is, the tax-free express lane where you can drive as fast as you want without ever paying a toll.
And conversely, the assets you use for tax loss harvesting, like your direct indexing account, those absolutely must be in the taxable brokerage account.
Because a tax loss generated inside an IRA is completely useless.
Completely. The IRS doesn't recognize it.
Well,
If we connect this to the bigger picture, optimizing that taxable account isn't just about avoiding capital gains tax. When you effectively harvest losses in a taxable account, you are actively lowering your adjusted gross income, or AGI.
and AGI affects so many other things.
Right. For clients who are nearing Medicare age, managing that AGI is absolutely crucial to avoid IRMAA surcharges.
IRMAA. That is the income-related monthly adjustment amount. It's essentially this hidden tax that spikes your Medicare premiums if your income is too high, right?
Yes. In 2026, those surcharges kick in when your modified adjusted gross income. Your MAGI exceeds $106,000 for a single filer,
Okay.
or $212,000 for a joint filer. Medicare looks at your income from 2 years prior. So proactive tax loss harvesting in those taxable accounts is a major lever.
By offsetting gains and reducing that AGI, you manage your AGI and avoid getting hit with massive premium hikes in retirement.
It's all deeply intertwined.
It really is. The tax loss saves you on capital gains, which lowers your AGI, which then keeps your Medicare premiums in check. It is a domino effect of savings.
A very lucrative domino effect.
So what does this all mean if your accounts aren't talking to each other? Because if we aren't looking at the entire household holistically, we can accidentally sabotage this entire system.
Oh, this happens more often than you'd think.
Imagine this scenario. You brilliantly harvest a massive loss in your taxable brokerage account. You swap the ETF, you bank the loss, you feel great about it.
You think you've won.
Right. But you completely forgot that your 401k or your IRA, which is managed on a totally different platform, is set to automatically rebalance on the first of the month. A week later, that IRA automatically buys the exact same index fund you just sold in your taxable account.
And just like that, the trap snaps shut. You have permanently destroyed your tax loss.
Wait, permanently, even though the purchase happened in a completely different tax-advantaged account.
Permanently. This is the biggest blind spot for investors who treat their accounts as isolated silos. The wash sale rule applies to the entire household.
The entire household.
It includes your spouse's accounts, and it absolutely includes your IRAs and 401ks. If your IRA buys that substantially identical security within the 30-day window, the IRS disallows the loss you generated in your taxable account. And worse, normally if you trigger a wash sale in a regular account, you get to add that disallowed loss to the asset's cost basis.
Which is, I guess, a decent consolation prize because it reduces your taxes later.
Exactly. But because this violation happened inside an IRA, the IRS doesn't let you adjust the basis. The value of that harvested loss evaporates completely.
That is brutal. So treating accounts as isolated silos isn't just inefficient, it is actively destroying wealth.
It is one of the most costly mistakes advisors see, especially when high net worth clients transfer from multiple brokers where maybe one person manages the taxable account and some algorithm manages the 401k.
They aren't talking.
No, you absolutely must have a centralized household view. A fiduciary has to monitor wash sale exposure across every single account in the household simultaneously to prevent those collisions.
Which perfectly highlights why wealth management has to be holistic. And, if we're zooming out to look at the whole picture, we also have to factor in philanthropy.
Yes, charity plays a huge role here.
There is a counterintuitive golden rule for charitably inclined families that the Davies Guide outlines. It's simply this: donate your winners, harvest your losers.
It is brilliant in its efficiency. Let's say you want to make a significant charitable gift. Instead of just pulling cash out of your bank account, you take highly appreciated stock, your biggest winners, and you donate those shares directly to a donor-advised fund, or DF.
And a D is basically a charitable investment account where you get the tax deduction immediately, but you could distribute the grants to actual charities over time.
Exactly. By donating the appreciated stock to the DF, you completely dodge the capital gains tax you would have owed if you sold it.
Nice.
And you still get to claim a charitable deduction for the full fair market value of the stock. Simultaneously, over in your taxable account, you are actively harvesting your losing positions.
So you are entirely eliminating the capital gain on your winning stock by donating it. And you are using your losing stock to generate a tax deduction that offsets other gains in your portfolio.
You are attacking your tax burden from both sides.
It's highly effective. And the source material also notes how this mindset pairs beautifully with qualified opportunity zone investments, or QOZs.
QOZs are fantastic for this.
How do those fit into the harvesting equation?
Well, let's say a client experiences a massive, unavoidable short-term gain. Maybe they just sold a business or a highly appreciated piece of real estate.
That is a massive tax match.
Huge. By rolling those specific gains into a qualified opportunity zone fund, which are investments designed to spur economic development in designated distressed communities, you can essentially hit pause on that tax bill.
Hit pause.
Yeah, you defer paying taxes on those initial gains until you sell the QOZ investment, or until a specific future date set by the IRS.
So you kick the can down the road.
Exactly. When you layer those QOZ deferrals on top of the continuous losses you are harvesting from your direct indexing strategy, you are building an incredibly robust, multi-layered defense against taxes eroding your wealth.
It is a totally different way of playing the game. We started this deep dive talking about how tax loss harvesting is often viewed as this rushed, annoying December chore.
Right, the scramble.
But walking through these strategies from Davies Wealth Management, it is so clear that it's actually a year-round, household-wide engine for building after-tax wealth.
It really is an engine.
For you listening, it is definitely worth asking your own advisor how actively they are managing this, especially if you have accounts spread across different platforms. The guide actually mentions a financial wellness quiz on the Davies Wealth Management website that could be a great starting point to see if your current strategy has any of these blind spots.
Before we wrap, I want to pull on one final critical thread from the estate planning section of this guide.
Oh, please do.
We've spent all this time talking about aggressively harvesting losses and building reserves to offset gains. But assets passed to your heirs receive what is called a stepped-up cost basis at your death.
Meaning the IRS essentially wipes out all the embedded gains on those assets when they are inherited. The tax clock resets to the value of the asset on the day you pass away.
Exactly. This raises an important question. Are you so aggressively trying to harvest losses and offset gains today that you might be disrupting positions you should simply hold on to until you pass away?
Oh, wow. That completely reframes the strategy.
Right.
If you hold a highly appreciated asset until death, the tax liability vanishes anyway. So why go through all the effort of harvesting losses to offset it now? You might be wasting those harvested losses on an asset that time, and the tax code would have solved for you.
If you expect to recognize gains during your lifetime to fund your lifestyle, harvesting is vital. But if you are planning to pass an asset to the next generation, a multi-generational view might completely flip the script on which stocks you decide to harvest right now and which ones you just lock away and leave alone.
So true wealth management isn't just about maximizing this year's tax return. It's about architecting a strategy for your entire lifetime and beyond.
It's about legacy.
It turns out, putting away the rake and stopping the frantic December cleanup is just the first step. The real work is building a system that runs in the background all year long, quietly compounding your legacy. Thank you so much for joining us on this deep dive into the true mechanics of high net worth tax strategy. We'll see you next time.